Alrighty guys, welcome back to another YouTube video, and in today's video we are going to be talking about premium versus discount. Now this is honestly a core key concept that you all should be utilizing every day within the markets. To keep it as simple as that, the market moves for two reasons, okay? The market moves to take out highs and lows, liquidity, and to rebalance ranges. And what you have to understand about these ranges is that we have premium and we have discounts of these ranges, okay? So let's just say that this is a range, okay? Highs and lows, okay? When we have a range like this, we can mark out the highs and the lows from the range like this, okay? And from this, what we can do is we can find equilibrium of this range. So in this case, if we were expecting, here, we'll show a better example. If we were, let's say, expecting price to continue to dump here, okay? So if we would want to see price continue to dump here, this is something that we would want to see. You would mark it out from this high up here to this low down here of this internal range, high right here, low right here. This internal range right here, you measure out the highs and lows. Anything past this 50% mark is going to be your discount. All right, so this right here, as we're tapping into OTE of this range right here, this 0.618 to 0.75 zone, this is OTE of this range. This is discount. This is when smart money enters the market to go short. I have some other examples for you guys to show. So when we look at this bullish example, we have the range right here. All right, this is price moving. We have this low, this high, right? So what can we do? We can measure out this range, high to the low right here. If we expect price to continue to be bullish, we would want to find an entry in the discount. All right, the discount is past the equilibrium of this range. So once price taps this equilibrium, that's when we, as retail traders, are looking to find our entry. Institutional money is already entering at that point. Institutional money enters in discounts, guys. All right, there's no reason for institutional money to be entering in premiums. They want to get the best price available, okay? And when you start to see the market in terms of that, that's when you start to realize kind of how everything moves. Back to this example, guys, for shorts, all right? If we would want to see short continuation, bearish leg right here, little rebalance, continue to be bearish, we would go from the high to the low. We'd want to see price tap this equilibrium mark, also discount, and that's where we would enter. That's where we would enter to see short continuation. All right. Institutional money enters in discounts. That's when you guys should be looking to enter your positions. All right. This is something to just keep in track, guys. Like, I will move over to a live example on the chart, and hopefully you guys will be able to see it better from that. But take this for example. All right. We have, beautiful, right here, this range. All right, we have this high and this low. All right, this high up here, this low down here. All right, beautiful range right here. This is beautiful. We are expecting short continuation ultimately to this low down here. It doesn't even look like this low gets hit, but we're expecting short continuation. All right, this is a bearish market right here. If we're expecting short continuation from this, we would want to see price tap into discount, which it does right here, guys. Price is tapping into discount right here. This is when smart money is entering the market. All right, this is when smart money is entering the market. And you see the same thing on ES with that. If we go to ES right here, we can look at the same range, guys. High to this low. We see ES, tap into this, and what do we see after that, guys? Bearish order flow shortly follow. I don't know if there, oh yeah, it does. All right, so yeah, there was a internal SMT also right here. So yeah, this is just an example, guys, of showing you, overall, if you're going to be bearish here, you want to make sure that price rebalances this range, tapping into discount, because that's when the institutional money is going to enter the market, and that's where you should be looking to enter the market and go short. Both hand in hand, long versus short. You want to make sure that what you're trading, the ranges rebalance. All right. As simple as it is, guys, just making sure that the range is rebalanced before you actually take a trade is so important. It looks like there may have been something here too. So like, for example, guys, if we edged this low right here, right? So if anything, I'd want to still see this low get hit. We're probably not taking it out right now just because it's Asia session and we're just generating liquidity to take it out. But for example, like you go, if you're expecting, still shorts here, guys, all right? So you'd still be expecting shorts to go to this low. You would go from this high up here to this low down here. All right. Once we see that, price ends up tapping discount once again and OTE, and we end up seeing a reversal lower. We don't end up fully taking out this low and whatnot, but it's Asia session. So what else do you expect? We're just generating liquidity. But it's a super simple concept, guys. And it's an easy thing that you can add into your trading to overall just make sure that the actual quality of your setups are better. And you have a clearer understanding of drawing liquidity for that day. And where the market is going to go, because the market should be rebalancing these ranges and should be, tapping into premium and discounts of that range. All right. You guys can go on any time frame and mark this out. All right. Premium and discount is literally everywhere. Last thing before I end this video, here are my settings for the Yan box that I use to mark out equilibrium and whatnot. So yeah. Hopefully you guys all enjoyed this video and were able to take something away from it, and I will see you guys in the next one. Peace.